Welcome to FinBot Insights. Today, we're examining a phenomenon that is often discussed among those who invest in covered call ETFs, net asset value lag, or NAV lag. The purpose of this explainer is to clarify what this term truly means and whether it should be a point of concern for you as an income investor. So, let us address this central question immediately. Is this so-called NAV lag a hidden force that is actively diminishing your investment returns? This is a frequent concern, and today we will determine whether it represents a genuine flaw in these funds, or if it is something else entirely.
To begin our analysis, we must first establish a clear and precise definition of terms. The words lag and erosion are frequently used interchangeably, yet they describe two very different outcomes for your investment. Understanding this distinction is fundamental to the entire discussion.
With NAV lag, it is important to note that the fund's net asset value per share is not decreasing. In fact, it is typically still growing. The lag simply describes the reality that this growth is occurring at a slower rate than the growth of your personal book value because your reinvested distributions are continuously acquiring additional shares.
NAV erosion, by contrast, is a far more serious condition. This describes a situation where the fund's per-share value is in a state of consistent decline. This often indicates that the distributions being paid out are greater than the income and gains being generated, leading to a decay of the fund's capital base.
Let us place these two concepts side by side. NAV lag represents slower growth, an upward value trend, and is an expected byproduct of the covered call strategy. NAV erosion, however, represents a steady decline, capital depletion, and points to a potential flaw in the fund's management or structure.
If NAV lag is not a defect, then what causes it? The answer is rooted in the fundamental trade-off that is at the heart of the covered call strategy itself. Let us now examine the mechanics of this process. A covered call ETF operates through a simple four-step process. It holds underlying stocks, sells call options against them, and collects the option premiums as income. It is this fourth step that is critical to our discussion. In exchange for that immediate premium income, the fund's potential for capital appreciation is capped. This is precisely where NAV lag originates. This statement truly encapsulates the proper way to view this dynamic. NAV lag should not be considered a flaw in the fund's design. Rather, it is an integral feature, the explicit and intentional exchange of potential capital growth for a higher and more consistent stream of income. This chart provides a clear visual representation of this trade-off. A standard equity ETF, shown on the left, derives the majority of its total return from capital growth. The covered call ETF on the right, however, demonstrates how the composition of returns is deliberately shifted away from capital growth and toward income generation. Having established what NAV lag is and why it occurs, we can now turn to the practical matter of how to manage it. There are several strategies an investor can employ depending on their individual financial objectives.
Several approaches can be taken. The full reinvestment of distributions is a powerful tool, as it uses the income generated to methodically increase your share count, which helps to offset the lagging NAV. Additionally, one can select funds that employ more conservative option writing strategies, for example, writing calls on only 50% of the portfolio to retain more upside potential.
Ultimately, your approach will depend on your primary goal. This table illustrates the spectrum of strategies. On one end, an investor seeking maximum income might accept NAV lag as a necessary consequence. On the other end, an investor focused on capital preservation will seek strategies that produce minimal NAV lag, even if it means a lower yield. We can now synthesize all of this information to arrive at a final verdict. Is NAV lag a serious flaw that investors in these funds should be concerned about?
The answer is not absolute. It is relative. It depends entirely on a single, personal factor, the primary objective of your investment strategy.
This is the critical distinction. For an investor whose main objective is capital appreciation, NAV lag will appear to be a form of underperformance. But for an investor whose primary goal is to generate a high level of consistent income, that same NAV lag is simply an acceptable and expected byproduct of a successful strategy. Therefore, we arrive at our essential conclusion. For the income-oriented investor, NAV lag should be understood as a feature of the investment, not a flaw. It is evidence that the fund is performing its stated function, converting potential upside growth into current distributable income.
If this explainer has provided you with a clearer understanding of NAV lag, we invite you to like it and to subscribe to Finbot Insights for more financial analysis designed to empower your investment journey. Thank you for your time.